Let's talk about Chapter 4. Chapter 4 is about financial planning, taxation, and the efficiency of financial markets. A few things as we go through the PowerPoint, I'm just going to kind of just bring up that are important that I think you should focus on as you read through the chapter. You'll find that this chapter is a little bit longer than some. A lot of terminology in the chapter and just a few things that you have to kind of just remember in terms of some of the retirement type stuff we'll talk about. It's possibly the first time some of you have come across some of these things, so it might be new information for some of you. And so the first part of the chapter deals with financial planning. Basically, what's the process that people go through to do financial planning? As you decide to budget, as you decide to meet with a professional to help you make decisions, and just some of the things that you set money aside for. So definitely funding an emergency would be a big one. Future purchases and retirement. Those are usually the big three for most people. You want to have some money set aside for an emergency fund. You want to save up for a down payment on a house, a down payment on a car, a vacation, whatever it is, just some big ticket item that you would like to buy. Then also, as your family changes over time, if you begin to have children, you probably start to think about, now I need to think about college or college planning. How do I pay for college for my kids? And how do I ultimately pay for retirement? So that's all a part of financial planning. And we'll learn as you read through the chapter that where you are in your life really helps guide what your goals are. Obviously the goals of a 20-something will be different. Just starting out with a job using their degree, you'll have different goals than somebody my age who's got college-age kids and closer to retirement than you guys are. So all that just changes over time. And so the financial life cycle is a big part of the first part of the chapter. It's on around page 99, you'll see that. And you go through a period of accumulation where you are building up your investment portfolio, you're saving, and then you get to the point of preservation, which typically is near retirement or retirement, and then after post-retirement, generally you're in the depletion level, at the depletion part. So you accumulate your wealth over time. At some point you take less risk and you're just more concerned about preserving what you have, but at some point you'll begin to deplete what you have. So a part of this chapter then is just some very basics about financial planning, and the advice I give everybody is don't be afraid to talk to experts, especially trusted experts. And if anybody wants my advice about somebody to talk to for financial planning, I will gladly give you some names of some USF grads who are doing this for a living that I trust and I know would give you good advice. So part of financial planning is understanding what you can invest in, understanding what your current financial position is, and then establishing a plan. And just know that once you establish a plan, you have to look at that plan every so often and decide, is that the plan that I still want to have? Do I need to make any adjustments to that plan? Has anything changed in the last 6 months to a year that requires a revision to the plan? So what we do first is we look at an individual's financial statements, and the book shows a couple of examples of those, and you'll notice in the book on page 101 is an example of a balance sheet, and then page 102 is a cash budget, kind of just think of it like a cash basis income statement, really. And so we're trying to figure out, what is your financial position, what do you own versus what do you owe, so hopefully have more assets and liabilities. And then your receipts and disbursements. How much cash do you have coming in? How much cash do you have coming out? And you definitely look at that on a cash basis. What we do is with financial statements says what we can do them based on today, where we stand today, but we can also do a forecast. Basically, it's just like a business would forecast financial statements. We can look at it from the same perspective and say, if I follow a plan for a certain period of time, what will my financial statements look like? Okay. So financial plans, once they've been established, need to be looked at frequently. Quarterly would probably be a good time, semi-annual, Annually wouldn't be bad either. You know, a lot of your investment funds, once you begin to invest, they will send you a formal quarterly return or a quarterly statement. And that's a good time to kind of just sit back and look at everything and make sure that the plan is working for you. Because your objectives may change, something in your life may change, birth of a child, maybe a divorce or a wedding, a medical issue that's requiring you to spend a lot of money, a change in jobs, whatever that is, something may change that you need to then go with this change. How does that affect my financial plan? So just monitor how things are going and then consider changes to the plan as life conditions change. Okay. And also, it's important to look at the returns you're receiving on your investments to make sure that you are getting the return that you thought you'd be getting when you chose those investments. Every time you make an investment, there should be a point of, I expect a certain return from that investment, and if I'm not achieving that return, the question should be asked why, and then maybe we think about investing in something else, an alternative to what we're doing now. And that deals with asset allocation, and that's where a financial planner is really good at offering this kind of advice, because a financial planner will ask you a lot of questions. They'll try to figure out what is your plan. They'll figure out how much risk are you willing to take. Are you risk averse? Do you want to play it safe, or just somewhere in between? And they'll help you kind of do an allocation of assets. The chapter on page 103 gives you a few examples within the chapter of how you might be able to allocate some assets, and kind of just based on what you'd like to do. So it could be so much in bonds, so much in mutual funds based on certain classes of stocks, small cap, medium cap, large cap, international. There's all kinds of different mutual funds. We'll talk about those in a future chapter. But a good financial advisor will help you figure out what that percent should be based on your age, your financial goals, your risk tolerance, your family situation. All those things will come into play to determine what the best allocation will be. Okay, so what asset allocation means is, just like I said a minute ago, is how do we allocate our investments into different type of investments? So the cash that we're investing on a regular basis, what percent or what dollar amount goes into a bond mutual fund, a stock mutual fund, or just stocks themselves, or anything else, maybe just some very safe investments like some treasury bonds, or just a money market, just as a holding position, just until we need that cash to buy something, whatever that might be. But just know that the different kinds of things we invest in will have different rates of return and different risk. And we just want to make sure that overall, as we look at our portfolio with all the different types of investments that we have, that we're making the right decisions, we're getting the proper return, and that our financial plan matches the assets that we're investing in. And that's where a professional really is good at helping us out. Okay, so that's just some very, very, very basic stuff about financial planning. I mean, very, very basic. That's just bare bones. And so I encourage you, as you begin to think about this, when everybody gets their first jobs and begins to think about a 401k and retirement, it's okay to talk to professionals. And again, I'm always willing to give out some names of some people that I trust who are all USF grads who would definitely help you out. We also have to understand the impact of taxes on financial planning. We talk about taxes in corporate finance. We have to talk about taxes in personal finance and just investments in general, because most investments are taxed. And so how do we plan for that, in basically make sure that as we make investment decisions, we have to think about the tax consequences of those. So we have to think about what's taxed. Income taxes, property taxes, and the federal income tax is progressive, meaning the more money we make as individuals, the higher the tax rate that we pay. The maximum tax rate is 39.6% right now for individuals. And so the more we make, at some point we get to that maximum rate and we have to pay tax. Okay, so a tax shelter is a way legally, through laws set up and IRS rules, where we can avoid tax, reduce tax, or defer tax. So a tax shelter is legal. We're talking about things that are legal in this class for sure. But there's things that are set up to help individuals, families, to either avoid tax, reduce tax, or defer tax. So we'll learn about what some of those are. And I should mention that those tax shelters, they begin to kind of talk about those starting about page 107, 108, is talk about retirement plans, and many of those are tax shelters to a degree. So some examples of tax shelters then, long-term capital gains, tax-deferred pension plans, and tax-deferred annuities. And a capital gain, so think stocks or just any investment, but it's easy to think of with stocks, is if I buy a stock and I sell it at a profit, I have a capital gain. Or if I buy a stock and I sell it at a loss, I have a capital loss. And they become a capital gain or loss once I own the stock for more than a year. Okay, so a capital gain is taxed at a lower rate than a short-term gain. A short-term gain, I pay my regular tax rate, whatever that is. And for most people, it's probably between 15 to 25%, somewhere in there, depending on your income levels. But a long-term capital gain, so a gain on a stock or any investment you held for more than a year, it's only 15%. So you pay a less amount for that. And you don't pay a gain until you sell the stock. If I buy a stock and just hold it forever but never sell it, there's no gain to pay. I don't pay a gain until I actually sell the stock, realize cash, then it becomes a taxable transaction. I got to pay tax on at the 15% rate. Okay, so long-term capital gains are a tax shelter because the tax rate is lower than your normal tax rate for most people. Then the next one's tax-deferred pension plans. So I'm sure most of you are aware of what a pension plan is. There's lots of examples of pension plans out there. In terms of the actual word pension, not many companies actually offer what we would call a pension anymore. Most governments do. If you've got a government job, city, state, county, school district, anything like that, most likely you probably have a pension. If you work for a private company, you might if you are in a company that has a union, but otherwise you probably don't have what we would call a normal pension. You can also purchase what they call a tax-deferred annuity, and then as that annuity grows in value, you don't pay tax until you begin to withdraw from the annuity. So it can build up a bunch of value over time as you put money into the annuity, and as it just accumulates and earns interest or dividends or interest as you build that annuity up, but you don't pay tax on it until you begin to withdraw. So I've mentioned a few things about capital gains, either short-term or long-term. Short-term is 1 year or less. So a short-term capital gain, you pay your marginal tax rate, just whatever your normal tax rate is, and I mentioned before that's between 15 to 25% for most people. Long-term, more than a year, it's only taxed once realized, in other words, when we sell it. Okay, so it's not taxable until we sell the stock and realize a gain. Then it's paid on at a 15% rate. You can hold an asset forever and never pay the gain. You don't pay the gain until you sell it. Okay, that's called a paper profit. You can do what they call a wash sale, and a wash sale is on page 106. And you can do a wash sale. It will, well, you can offset capital gains with capital losses. Okay, long term against long term. But a wash sale will disallow the tax benefit for a capital loss. So just be aware of that. And just read on page 106 what it says about a wash sale. I think you can read it better, understand it better than I can just explain it to you. But if you just read page 106 about wash sales, you know that. So just know that you can offset capital gains against capital losses unless you have a wash sale, which will disallow a capital loss. So a wash sale is a way, a rule to prevent people from kind of gaming the tax code, more or less. How you offset gains and losses. First, short-term losses offset short-term gains. Second, long-term losses offset long-term gains. And then third, net short-term losses offset long-term gains, or net long-term losses offset short-term gains. So that's kind of an important slide. So just make a note, slide 15, and this information about this is on pages 106 and 107. When we do some of the homework problems, which I'll show you in class, we're going to need this information. So just FYI, just make a note, slide 15 of chapter 4 you might have to refer to when you do the problems. And actually this one too, 15 and 16. Fourth, net short-term or long-term losses are used to offset income from other sources. But there's a limitation, the $3,000 for filing jointly, or $1,500 for an individual. Anything above exceeding the $3,000, $1,500 limit are carried forward. So you can only offset so much in losses in 1 year against gains. If you go above the $3,000 or $1,500, depending on if you're filing jointly or separate, then you carry that over to the next year. And corporations are subject to this kind of the same type of a deal too. Okay, pension plans is the next one. Pension plans, there's two types, defined benefit or defined contribution. A traditional IRA is a very common type of an investment. Not covered by a pension plan, contributions are deductible from taxable income. So sometimes what you'll see towards the end of a tax season, like late March, early April, what you'll see is advertisements for IRAs, because you can do that then. So let's just say, let's go back in time and say it was April of 2016, and we're putting together our tax return for 15 and realizing we might have a tax bill. Well, one way to offset our tax bill would be to buy an IRA, and that you can put up to so much money in it per year. It's $2,000. Let's see, the book mentions how much they are. It's $5,500 per year, and what you can do is that's tax deductible. Okay, so you can deduct that from your taxable income and not pay any tax on that amount that you put into an IRA. It's subject to limitations based on your income, though. The more income you have, basically the less deduction you get for putting money into an IRA, because the tax code is progressive, so that's part of the reason for that. So it's subject to some limitations. But just know that money you put into an IRA, that's tax deductible. You don't pay tax on it. When you buy an IRA, you decide where to invest your money. Quite often, you buy that through a financial services company of some sort, and they'll give you all kinds of choices, mutual funds and whatnot, to put your money into. And generally, you work with the company that you bought it from to say, here's what I want to do, or you ask for advice, or it's really up to the individual. So you control how the money is invested. So because you did receive a tax deduction for putting the money in the IRA, they're taxable when you take the money out. So anything that you take out of the IRA is taxable, is taxable. Okay, then we have what they call the KEO, or the HR-10 account, and this is kind of like a 401k or a pension, only for self-employed people. Excuse me. So you have a limit of 20% of your earned income. So as you do your tax return, you'd compute your earned income on the tax return. 20% is the amount of the contribution that can be deducted from your income. Up to 20% of earned income can be deducted. So again, you deduct from taxable income anything you put into the KEO or HR-10, subject to limits. And again, you choose how the money is invested. And so just like an IRA, because you receive a tax benefit for putting the money in, you pay tax when you take the money out. So it's taxable. Any withdrawals are taxable. Okay, 401k and 403b, they're the same thing. Because I work at USF, and USF is a nonprofit, they have a 403b. A for-profit company has a 401k. They're the same thing. They work to the same end game. Basically, employees put money in. Employers may match that. They don't have to match it, but most do. And then that money's put into your retirement account, where you choose to invest the money. So it's a plan offered by your employer. The vast majority of employers nowadays, this is what they offer as a pension plan. Okay. The reason that they do that is they don't have to carry any liabilities. When a company offers a pension plan, there's a whole bunch of liabilities you have to carry with pension plans, with traditional pension plans. But with the 401k, it's just an expense. You just basically you match employees' contributions if you want to. You don't have to. And anything that you contribute to your employees is just simply expense. It's just basically compensation expense every pay period that you make the contribution. So most employers, what they'll do is match up to a certain point. For example, 3% is kind of a common number. So if you put in 3%, they put in 3%. Very, very common way to do it. I worked at one company. I was a 401k administrator when I was at Lloyd Companies. And we put in 3% no matter what. So everybody got from the employer 3% no matter what. Even if the employee didn't put a penny in, we still put in 3% of their salary into their 401k. And so it's a very simple process. We worked with the Hartford companies. That was the company that took care of it for us. And so what I did every payroll is basically we put in 3% of everybody's gross pay into their 401k account. I had to log in, go to a website, update everybody's contributions that we did, and then once we knew what that number was, we wrote a check to the Hartford, and then that was just simply debit expense, credit cash, and so there's no liability for us to carry. On the employee side, then they can put in what they want to. The maximum you can put in is based on your age and your income, but it's a pretty high percent. You could put in like 15%. If you really want to go crazy, you can do a high number if you really, really want to. So contributions from the employee side reduce taxable income. So when the employee puts money into this, it's tax deductible. They don't pay tax on anything put into their 401k. And it's very common, like I said, that employers will match what you put in. Assets in the account are chosen from alternatives determined by the employer. And so again, we used the Hartford, and they had probably more than 100 mutual funds that employees could choose from to put their money in. You can put your money into 10 different funds at 10%. It's really up to you how you chose to allocate your funds. And again, that's kind of where you would ask a financial advisor based on your age, your retirement goals, your family situation, how you want to allocate your assets. All withdrawals are tax deductible. Just think, because I get a tax deduction for putting the money in, that means it's taxable when I take the money out. Okay, because I got a tax benefit by doing the contribution, therefore I have to pay tax on anything that I take out. Okay, so there's one other kind of IRA though, called the Roth IRA, and this is kind of a cool deal, and I want everybody to kind of just make note of this and how this one works. Contributions are not deductible from income. In other words, you're putting in after-tax dollars. So whatever money you contribute to this is not tax deductible. However, the nice thing is the money I take out is now non-taxable. So it works the other way than a traditional IRA. And again, I choose how the money's invested. I can go crazy and choose a bunch of high-risk stuff or a bunch of safe stuff or anything in between. It's really up to me how I do that. But anything I take out is not taxable. So this is a great way to build wealth and not have to ever pay tax on it. So Roth IRAs are a great vehicle for accumulating money for retirement that will never be taxed. Okay, so it's a great deal. So you don't get the tax benefit up front, but you get it when you take the money out. So the question then becomes, what's deductible versus non-deductible IRAs? And they talk about that too. I should mention pages 110 and 111 give you a couple of examples about that too. The importance of the tax rate. What's the tax rate when the funds are contributed versus when the funds are withdrawn, right? That's important in tax planning and determining what kind of IRA is best for you. Okay. Tax-deferred annuities is on page 111. It's a contract for a series of future payments. Remember, the definition of an annuity is a series of equal payments that are the same. Okay, so basically what you do is you buy a contract today, and you can continue to buy annuities. You can just buy an annuity with a bunch of money, put it down, and let it sit there and accumulate value, and then receive a series of payments at some point in time. Or you can make a bunch of equal payments into an annuity, but at some point it will mature and then begin to pay you a benefit. I A tax-deferred annuity, income earned by the investment, is not currently taxable. It's only taxable as withdrawn. So basically, as it builds value, as it goes up and earns interest or dividends, it goes up in value, all tax-free, until you begin the withdrawal process. Then you pay tax on what you take out of it. So it's a tax shelter in that you defer the tax. You build wealth pre-tax, and then pay the tax on the backside as you take the money out. Okay, so that was some tax vehicles that are tax shelters, or some retirement vehicles really that are tax shelters. And remember, a tax shelter is a way to either avoid tax, lower tax, or postpone tax. Okay, any of those types of things is a tax shelter. Everything I showed you was legal. It's all part of IRS code and all that good stuff. So it's important to kind of know the basics of some of those things, though, so that you can make informed decisions as a consumer. Okay, so the rest of the chapter deals with the efficiency of financial markets. So I think mostly the stock market is probably the way to think about it. And it says the efficient market hypothesis is that you cannot expect to beat the market consistently on a risk-adjusted basis. Earning a higher return is not necessarily outperforming the market, but you have to consider risk. So if you do beat the market in terms of return, the question was, did you take on more risk than you needed to beat the market? That's really what they're saying here. Is that why you beat the market? Because you took on more risk, and was that really smart? So the efficient market hypothesis is on page 112. Basically a theory that the stock prices correctly measure the firm's future earnings and dividends, and that investors should, let me say that again, an investor should not consistently outperform the market on a non-adjusted risk basis. Okay, so it's basically saying it's hard to beat the market. So there are some assumptions that go into this hypothesis, and again, page 112 and 113 is where you should look. There's a lot of people in the market, right? There's millions of people and other corporations and financial professionals in the market. Anybody can get information easily, right? If you have a smartphone, you can get all the information you need about a stock. Anybody can, right? With the internet and the information age that we're in, we can all get this info right away. And transaction costs are small. It's $7, $5, sometimes free to make a trade depending on how much money you have in your trading account. So it's very minimal. It's low cost to make a trade, to buy or sell. Not expensive. So that results in frequent transactions, a lot of transactions. And so with a lot of information and a lot of transactions implies efficiency. Okay. So the random walk is one term for efficiency, and it's on page 113. Basically, the random walk means that price changes are unpredictable and patterns formed are accidental. Okay, so basically it just means that the day-to-day price changes are random. It does not imply that securities prices individually are randomly determined. It just means the changes that happen on a day-to-day basis can be random. Quite often they change not because of anything the company itself has done, but just because of general economic news. Something good or bad happened overseas in the financial markets. Some major weather event, some major terrorist attack, unfortunately. All those things can move the market generally for the down, and the company might have just reported some really good earnings, but the market generally will go down. And so that's why we say the day-to-day changes are random, but that does not mean that the price of any one security is randomly determined, because that price is based on the dividends the company pays, the cash flows the company produces, what investors expect about the future of the company. Those all come into play to determine what a stock individually is worth. But the day-to-day changes can be quite random. It also means that successive price changes are independent, that just because it went up for a few days in a row doesn't mean that's a trend that's always going to happen. Clearly, we all know that. You have to look at each price change independently. You can't just say it changed today because it changed yesterday. You can't necessarily correlate the change today to the change from yesterday, the day before, the day before that. Today's price does not forecast tomorrow's price. We know that. But we do know one thing is that current prices embody all known information, and you can say that about any stock. All the information known about a stock is what determines its stock price today. Okay, so that's the efficient market, right? So basically saying that everybody knows everything, and all that information is boiled down to what the price is today. It also says that new information must be random. If that information is not random, then an opportunity to earn an excess return would exist, and that opportunity doesn't really necessarily happen consistently. You can get lucky in a market, you can get lucky on a stock. We all know that. You can get lucky with almost any kind of a financial transaction, buy low, sell high. Just you bought a stock just because you thought it was a good stock, but all of a sudden they reported great earnings, or all of a sudden demand for that stock goes way up and your price goes way up more randomly than anything else. So just know that that's very possible. Prices change quickly based on new information. We know that. And then by the time investors know the information, the price has already changed. So if you are watching the morning news and you see something on the news that says this, drug co just got a new drug approved and expect to sell a whole bunch of it and make a bunch of money, the stock price already reflects that. You can't log on to your E-Trade account and buy that stock low and sell it high necessarily, because when you log on to your account, everybody knows this information, and the stock price already reflects that. Okay, so by the time you learn something in the news, everybody knows it, and the stock price already reflects that. Now, if you think this is going to continue to go up, then buy it definitely. But you're not going to get on anything. You're not going to get in on anything that nobody else doesn't already know. This is on page 114. This particular graph. It just says, price adjustments. This is the daily closing prices for Google over a period of time, and it shows you a line that says price adjustment in an inefficient market. And just know, again, what this is really showing us is that the speed of transactions, the speed of price adjustments happens very, very quickly. And that information, as it happens so quickly, it immediately affects stock price. Okay. So the question then becomes, how efficient is the market? I think we can all agree that the markets are efficient. That's part of having a well-oiled and a good financial system in our country that promotes a very good economy. The question then becomes, how efficient is the market? And there's different theories here, and there's nobody. You can get a dozen people who are finance experts in a room and get a dozen different guesses or beliefs or understandings about markets and efficiency of the markets. So just know that. It's kind of like economists. Ask an economist a question, ask 12 economists a question, and get 12 different answers. And in finance, it can be that way too. So the forms of the efficient market hypothesis are the weak form, semi-strong, and the strong form. And these are all on page 115. The weak form says that studying past price and volume data will not lead to superior investment results. The weak form suggests that using price data will not produce superior results. Using financial analysis may produce a superior return. So we'll focus more on the financial side, doing ratio analysis, really digging into a company's financial statements, and then making decisions based on that, as opposed to just volume data and past prices. The semi-strong form, studying economic and accounting data will not lead to superior investment returns. Studying inside information may lead to superior returns. So if you really just get into the nuts and bolts of a company, what that kind of means is you become an expert in that company. Any news release that comes out, any earnings call, any press information about that company, anything that a top officer says in the press, just anything you can find about that company, you're just looking for information. You're not trying to steal inside information by any means. You're just using legal means to get all the information you can about a company and just trying to figure something out before generally everybody knows it. And then making a decision to invest based on that. So you have to really do your homework on a particular company to be able to beat a stock price. In the strong form, using inside information will not lead to superior investment returns. Basically just saying the market's so efficient that there's just no way to really ever beat just investment returns. You're just not going to beat it. It's just not going to happen, no matter what you do. Okay. Now it mentions here anomalies. So there's always anomalies in the markets. Page 117 talks about that. The weak form and the semi-strong form, or a couple of them there. Possible exceptions of the efficient market hypothesis called anomalies do appear to exist. So just know that there are some anomalies in the efficient market hypothesis. Examples. The low price to earnings stocks. So stocks that have a low multiple of price over earnings, generally they're really small companies that don't have much of a track record. Very small firms, very, very small companies that just don't get a lot of attention. Investment analysts aren't looking at them very closely. And that's also the January effect. And the January effect deals with timing. January effect deals with the first 5 trading days of the market, of the new year in the market. And the reason for that is that investors typically buy stocks in January after selling them in December for tax reasons. So that's part of what the January effect is. The neglected firm effect, basically the small firms are neglected by large financial institutions. In other words, they don't get a lot of press. They don't have investment analysts covering them because it's not worth their time, things like that. There is a website called Fool.com, Fool.com, and they actually specialize more in these types of companies, helping investors find these types of companies before they hit it big. So there's ways to kind of beat the market by finding these types of companies. There's websites that will help you find them. Fool.com, a lot of their stuff is free. You can pay for some of their stuff too. There's also what they call day of the week effect, overreaction effect, and drifts in prices. So these are all on page 118. Day of the week effect, basically they're saying that possibly the day you buy something might give you a better position on a stock. Overreaction is a tendency of securities prices to overreact to new information, which can happen. And the drift effect, basically, a stock might drift in a particular direction over a time period after a surprise announcement of some magnitude. Generally, what I've seen happen in markets is when something, some negative financial news happens, and the market might go down a few hundred points, and so stock prices, all stocks come down when that happens generally. Quite often that might last a couple of days, and then people start to buy because they're going, well, these stocks are quote unquote on sale because the market went down just due to some negative thing that really maybe has no long-term impact on our economy or on the companies in the market. And so investors will quite often jump in and buy up these stocks and then sell them at a profit at some point in time. So there's ways to beat the market like that, but it takes a lot of time and effort and, of course, more risk. Generally, for most people like me and you, I would say just buy a stock that you like and hold on to it for a long time. That's really your best bet. Empirical evidence of the existence of an anomaly does not mean individuals can take advantage of the anomaly. It's hard to do that, and it can still exist, and the market can still be, fairly efficient from the perspective of any individual investor. And so just so you know, just overall, as you look up the price of a stock, just know that that price does reflect all known information about that stock. The playing field is level, and that specifying financial goals may be more important than seeking undervalued stocks. So just having a goal, saying, if I match the market, I'm fine. I'm okay. Remember, I've talked about it in class that the market will generally get you about 8% per year. Some years will be really good, some will be really bad, and some will be okay. But if you think long term, you have long-term goals, you'll be fine. If you just keep your money in the market, generally you're going to be okay. Okay, so that's just something to think about. We'll talk about mutual funds in a future chapter, which is a great way to invest. If you're not sure what to invest in, a mutual fund is a good way to go.